has correctly said, in the world of finance, trust is a very precious commodity and it's easily eroded by deceptive metrics. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In the previous episode, we have discussed the cash flow manipulations and acquisitions. In this episode, we are going to discuss the key metric manipulations and acquisitions. In the realm of corporate finance and merger and acquisitions (M&A), there is a well-established body of academic research that suggests that a significant portion of acquisitions end up destroying the shareholder value rather than creating it. This is a critical concern for company management because they need to persuade investors and stakeholders that a particular acquisition or a merger is in their best interest. Manipulating the key metric refers to the practice of manipulating the key financial metrics and performance indicators to present a business combination or acquisition in an overly positive light. By doing so, management can make the deal appear more attractive and beneficial than it might actually be. In the recent years, there has been a noticeable increase in the use of the misleading non-standard metrics by the company's management that are actively involved in the acquisitions. Non-standard metrics are alternative financial measures that don't adhere to the standard accounting principles and are often used to present financial results in a more favorable manner. When such metrics are manipulated or presented selectively, they can create a misleading picture of company's performance and the result expected benefits of an acquisition. When assessing a company that has recently completed an acquisition, it's crucial to understand how the acquisition has influenced the reported revenue to determine what the growth rate would have been without this transaction. Acquired business results are immediately included in the financial reports following the GAAP guidelines, or in our case, the Indian Accounting Standards guidelines, resulting in an artificial boost in the reported sales growth. To gain a more accurate understanding of the true underlying growth rate, investors can employ various strategies. One effective approach is to look for footnote disclosures provided by the acquirer. These disclosures often present sales figures on a pro forma basis, incorporating results from both the recently acquired businesses and the legacy business. These figures are typically available from the beginning of the year, allowing the investors to calculate the year-on-year growth rate for the combined business units. This pro forma disclosure can be highly informative in assessing the overall growth performance. Alternatively, acquirers may reveal the contribution of the target company to the total revenue after consolidation. This disclosure offers sufficient data for the readers to estimate that what the reported results would have been in the absence of the acquisition. In cases involving significant acquisitions, it is advisable to thoroughly review all the available disclosures and engage in a detailed analysis to extract the genuine growth rate of the legacy business and the acquired business and the combined entity. This comprehensive approach will help us to uncover a more accurate picture of the company's actual growth trajectory, free from distortions caused by recent acquisitions. It is also very essential to be vigilant when examining all these things because simple data, a small amount, can also play a very important role when examining how companies define and calculate the organic or forma sales growth, as their methodologies can sometimes be misleading as well. Take, for instance, the example or the case of Affiliated Computer Systems (ACS) and its unusual approach to presenting internal growth. ACS referred to its organic growth as internal growth and didn't simply exclude all the revenue from the acquired business in its calculations. Instead, ACS employed a fixed amount to subtract based on the acquired company's revenue in the previous year. This unique approach allowed ACS to include any significant deals made by the acquired company just before the acquisition in its internal growth figures. For instance, let's imagine ACS acquired a company on January 1, 2005. In January 4, 2004, the target company generated $120 million in revenue. That is basically $30 million per quarter, right? So shortly before the acquisition, the target company, because target company means the company which is to be acquired. So the target company secured a substantial deal, adding an extra $10 million in the quarterly revenue starting in 2005. In March 2005, the first quarter post acquisition, the target company produced the expected $40 million in revenue, 30 million plus 10 million, the extra content which it got. Logically, when calculating the ACS internal revenue growth from March 2005, this entire $40 million should have been excluded because it wouldn't have been the ACS revenue part without the acquisition. However, ACS calculation allowed the inclusion of the $10 million contract as the part of its internal growth, leading to an inaccurate portrayal of the ACS internal revenue growth that benefited from the acquired company's revenue. The key takeaway is to closely scrutinizing the organic growth calculations of the acquisitive companies, as they may incorporate a revenue that originate from the target company and could potentially distort the true picture of their growth. Companies involved in frequent acquisitions often incur substantial deal related costs, legal, investment banking, integration expenses. Management has the flexibility in categorizing these costs as one time in nature and placing them below the line, effectively guiding the investors to ignore them in the favor of considering only normal recurring operating costs. In theory, this approach makes sense as one-time costs should not recur in the following years. However, for companies consistently engaged in acquisitions, these costs can become recurrent and a regular part of their cost structure. Moreover, some companies may improperly shift certain normal recurring operating costs like selling, R&D, administration expenses below the line into the non-recurring category. Investors should exercise skepticism when standard earnings substantially lag behind the quote unquote adjusted earnings or non standard metrics. A useful rule of thumb is to compare the non standard metrics with their corresponding standard counterparts. If non standard adjusted earnings closely align with the standard net income, they can be considered legitimate. Not always, but yeah, generally. However, if the non-standard metric consistently portrays much better result compared to the standard equivalent, investors should be cautious and may need to reject the non-standard metric as potentially misleading. To illustrate this, consider Valiant, which highlighted its stellar performance using the non-standard metric, quote unquote, cash earnings. Over 3 years, 2013, 14, 15, 2013 to 16, 3 years, Valiant reported a cumulative standard net income of negative $2.7 billion. In contrast, the company boasted a cumulative non-standard cash earnings of positive $9.6 billion, a significant difference of $12 billion. This stark contrast between the non-standard metric and the standard equivalent raises red flags. Furthermore, in a chart illustrating in the variance gap versus the non-standard profits from 2013 to 16 in the book, it's evident that the standard net income was often negative and close to zero. An exception was Q4 of 2014, where the standard net income approached $500 million, but this figure included a one-time gain of 287 million. It was a pre-tax gain on the sale of its stake in the another business. Thus, this gain should be considered one-time in nature, emphasizing the significant gap between the standard and the non-standard earnings, which could be even larger than $12 billion in many companies. Here comes the end of this episode. Thanks for listening to this episode. See you in the next episode. Until then, keep learning, keep questioning, and keep exploring. the captivating world of finance. Thank you and have a nice day.